Well, good afternoon or good morning, wherever you are located for this webinar. My name is Nathan Mercereau from Planning Alternatives, and I am pleased to announce our webinar, Tax Tips for 2015 and Beyond. This is the time of year to consider planning for your taxes and the return that you complete in April. Many times people get caught in their tax preparation steps and say, boy, I wish I had done something in the previous tax year. And this is why we're having our webinar today, to give you an opportunity to just pause, consider some of the strategies that might be relevant for you in 2015. And between now and the end of the year is the time to look at this and potentially do something about it. We have the largest number of attendees of our webinar series this year, and so this really points to the importance of this topic and just the timeliness of the presentation. Today's format is going to be a 35-minute presentation, and at the end we'll have some time for questions and answers. If you look on your screen, there will be a place where you as an attendee can submit questions as we go through the presentation, and at the end we will review those questions and ask them to our guest presenter. We are not accountants. We're not here to give tax advice. This is an educational session, and we certainly encourage you to go to your CPA, go to your accounting professional, and discuss these topics before you have any direct implementation. And of course, we as your advisors are here to coordinate with your tax professionals to make sure everything is done in a coordinated fashion and in your best interest. Today's webinar will basically be a unique format where we are very pleased to have a guest speaker, John Nersessian. He's the Managing Director of Wealth Management at Nuveen Investments. Along with myself, Jim Nazinski, a wealth advisor here at Planning Alternatives, is going to basically interview John. We are the on-the-street reporter, and we are so pleased to have John with us. John is recognized in our field as an expert on investment counseling, financial planning. I met John at a national conference a few weeks ago, was incredibly impressed by his presentation, and we are so fortunate to have John here for our webinar. So John, welcome, and thank you for taking time out to share with us today.
Hey John, it's Jim Nazinski, and we sure are happy to have you. So why don't we begin on this exciting adventure of the world of tax planning? And if you would start by sharing with us the basics of what we need to know about the current tax system in order to plan more effectively, and then of course share with us the tips and strategies that we ought to consider.
Well, thanks both Nathan and Jim. I really appreciate the opportunity to be with you today. It is a special day. Not only are we going to be discussing taxes for the purposes of helping our audience better understand the tax system and some of the smart things they can do to minimize their tax bills, but today is a special day for another reason as well. Today is Nathan's birthday. So for those of you on the call, never reveal my secrets. So for those of you who are so inclined, it might be a nice gesture to send them a little note celebrating this very special day.
Thank you,
John.
Let's move forward. I appreciate that.
Oh, you're more than welcome. Let's move forward with the topic of the day. Let's start first with a quick little review of what's changed in the world of taxes. Many of you probably remember the American Taxpayer Relief Act. It was the most recent form of tax legislation, and it did a couple of things. Number one, it extended the Bush income tax rates for those in middle income tax brackets. That was good news. It did increase the top rate on earned income for those at the highest income levels. There's a new rate in town. That rate is 39.6, and obviously that changes the calculus regarding some of the financial decisions before us given this new rate. And then either good news or bad news depending on your perspective around the AMT. Number one is AMT was made permanent, and so AMT is here to stay. It's a reality that we will need to deal with. The good news is we now know the rules around AMT, as the AMT exemption, which had been patched on a temporary basis in prior years, that was made permanent. So good news is we know the rules. Bad news is AMT is here to stay and a reality that we will deal with in coming years. Let's go to the next slide. So one of the questions that's often asked is, how could tax legislation change? And depending on what you read or what you watch, there are a couple of different proposals that are on the table for 2015 or 2016. I actually had the opportunity to leaf through the Obama budget proposal, and there were some, of course, tax implications within it. Depending on which side of the aisle you look, there are different possible outcomes. The Democrats want to, of course, limit deductions. There's the concept of the Buffett rule that would impose a minimum tax rate of 30% for higher income earners. There could be a capping of retirement benefit accrual so that the Mitt Romneys of the world would not be able to build a significant war chest in a tax-protected account, denying the government the opportunity to collect their fair share of the tax burden. Another concept that's been discussed is the elimination of the stretch IRA. One of the things that your planners, I'm sure, have discussed with you or potentially incorporated into your financial plans is this concept of a stretch IRA that would allow you to leave assets to certain beneficiaries and elongate the compounding process for greater tax benefit. The Republicans come at this from a slightly different. Their goal might be the investment income tax that we'll speaking about a little bit later. One of their ideas is to potentially repeal Obamacare in full and the associated taxes that come with it. None of these are guaranteed to emerge in 2016. We'll continue to follow the news closely to see if any of these changes actually see the light of day. Here are the new tax rates that I made reference to a little bit earlier. These new tax rates are 10% at the low end, rising all the way to 39.6 for taxpayers with income levels of $465,000 or greater. Keep in mind that new rate does not include the 3.8% net investment income tax and the 0.9% Medicare tax. Those are two additional taxes that are associated with wages and investment income that need to be considered in this conversation. We'll take a look at that in a moment. Let's go to the next slide. I made reference to these Affordable Care Act taxes, and they do affect higher income earners, those that with income levels of $250,000 or greater if you file a joint tax return. Here are the two key taxes that I spoke of. A 0.9% tax to pay for Medicare. That tax is applied against wages, compensation, and self-employment income. So whether you're a W-2 earner or a self-employed entrepreneur, this 0.9% tax would be added to your tax rate for income above $250,000. For those who are active investors, and I suspect most of us on the line are, there's an incremental tax on investment income. It's a 3.8% net investment income tax, and that tax, once again, is levied for those with income levels above $250,000 on their investment earnings. That includes interest, dividends, annuity distributions, rents, royalties, and maybe just as importantly, net capital gains. The capital gains that you realize in your portfolios, whether they're through distributions of mutual funds you own or through the sale of appreciated securities within your portfolios, be aware of this 3.8% net investment income tax. Let's go to the next slide. Long-term capital gains and dividends still are taxed at a preferential rate. It's just that the rate is not as preferential today or as advantageous as it was a few years ago. Take a look at these capital gain rates. 0 for income up to $75,000. A 15% rate between $75,000 and $250,000. At $250,000, the 3.8% net investment income tax kicks in, bringing the marginal rate up to 18.8%. And at $465,000 and above, with a rate of 20% on capital gains, plus the 3.8% net investment income tax, the total rate is approximately 24%. These rates are higher than they were a few years ago, But I do want to make an important point. It's the difference between dividend and capital gain rates that are lower on a relative basis than ordinary rates. That spread between the two remains exceptionally high, encouraging us as investors to produce returns that are long-term in nature or that consist of qualified dividends. Very attractive rates relative to the 39.6% ordinary rates that we would otherwise be subject to.
Hey, John, I have a question.
Yeah.
I don't think that many taxpayers realize that there's a 0% capital gains tax bracket. Might you offer an example of how someone might take advantage of that opportunity?
Yeah, Jim, that's a great point. Most of us, of course, are familiar with the regular income tax structure that starts at 10, but on dividends and capital gains, there is a 0 rate. There's a 0 rate for income below $75,000. So what are the planning opportunities? Number one, for some of us, maybe our income dropped temporarily. Maybe we were between jobs or recently retired. And if our income levels drop below those on the screen, there may be an opportunity in 2015 to realize those gains with a 0 capital gain tax. Another opportunity would be capital gain shifting, maybe from a parent or a grandparent down to a child. If our children are not making significant earnings, in other words, below the $75,000 level, we can transfer appreciated assets to those children where they would realize those gains at this 0 rate. Now, one caveat, please, which is to be careful of the kiddie tax rule, which does apply to qualified dependents. So please speak with your advisors to make sure that you don't run afoul of the kiddie tax laws, but be cognizant of this idea that there is a 0 rate there that can be used advantageously in certain circumstances.
Excellent. Thank you, John.
So let's now talk about a couple of phase-outs. So we know that taxes are higher, that the IRS or the government is going to get a larger percentage of our earnings through higher tax rates. What may not be as obvious to many of us are the incremental ways in which our tax bills go up due to 2 phase-outs that I'd like to address now. The first is called the personal exemption phase-out, or PEP. The personal exemption is $4,000 per person in 2015. The personal exemption phase-out suggests for those earning income above 3,099, they will lose 2% of their personal exemption phase-out for every $2,500 of income above the threshold amount. I know the concept is a little confusing, but let's focus on the broad implication. It's the idea that if my income exceeds a certain level, I will lose my personal exemption. We've provided you with an example of that on the slide before you. Here's how I come at this. It's nice that we know about it. I'm not sure that there are many planning opportunities to deal with it. After all, the $4,000 personal exemption is nice, but it may not be the biggest financial consideration in your overall financial landscape. I'm not sure that any of us would necessarily take an action of delaying income or accelerating deductions specifically for the purpose of maintaining our personal exemption. The next phase out does require some planning. Jim, if you'd go ahead to the next slide. Here it is. It's called the peace limitation. And for those of you who have been around as long as I have, this may be somewhat familiar to you. This is a part of the tax code that was around about 20 years ago. It was repealed or eliminated from the tax code, and unfortunately, it is now reemerged. Here's how it works. It affects our itemized deductions. Itemized deductions, of course, show up on your Schedule A. They include your mortgage interest. They include your state and property taxes. They include your charitable gifts. They include your unreimbursed business expenses, etc. These Schedule A activities are now limited regarding their deductible benefit for high-income earners. If your income is below 3,099, no problem. You're enabled or entitled to enjoy the full benefit of those deductions. For those with income above the threshold, here's how the peace phase-out works. You lose 3% of your itemized deductions, subject to a maximum reduction of 80% of your deductible amount. Forget the math for a sec. What does it mean? What this suggests is it's more important than ever to consider the timing of both your income receipt and your deductible activities to enjoy the maximum benefit given this new piece phase out. Obviously, the planners that you work with can help you in this issue. They can crunch some numbers for you to suggest when it may make sense to accelerate or defer income or expenses. We've provided an example on the following page showing the impact in a hypothetical illustration of this piece phase out and the impact on itemized deductions.
Okay, John, this is great because you're laying out the ground rules of the tax system within which we need to work. We've heard about ordinary income rates, Obamacare taxes, capital gain rates, and now you've told us about PEP and PEAS, which, by the way, to me sounds like a vitamin supplement or an energy drink. But there's another area of the tax system that's quite a mystery to many people, and that's the alternative minimum tax, or AMT. Would you tell us what we need to know about AMT?
Sure. Be happy to provide some basic planning ideas around AMT. AMT was introduced in 1969, and it's a parallel tax. What I mean by that is we run our taxes under the regular code first, taking our deductions and exemptions, and then applying those numbers against a progressive rate structure that starts at 0 and goes to 39.6. We calculate our tax bill under the regular code. Under AMT, we now run the numbers a second time. We lose some of the deductions that we enjoy under the regular code. We are unable to deduct state income taxes. We add back in our property taxes. We add back in additional deductible activities to report a higher level of income. We then receive an exemption amount that is subject to a phase out, and we apply a flattish rate structure of 26 or 28%. Of course, we pay the tax bill, whichever is greater. We compare our regular tax bill against the AMT bill. Whichever those numbers is larger is what the IRS expects to receive. Here are the numbers under AMT. You can see that you deal with a 26% rate for those earning income below 185. For income above 185, the rate is 28%. As I mentioned, we do receive an exemption. That AMT exemption amount starts at $83,400. That essentially replaces the deductions that are lost under the more restrictive guidelines of AMT. Once your income exceeds $158,000, though, you lose 25% of your exemption until you reach $492,000. At that point, you've completely lost the AMT exemption amount. Now, here's how I would think about AMT. I really don't want to get too granular on the issue. I don't think any of us have an interest in completing an AMT tax return. I suggest what we probably are interested in understanding is whether or not we would be affected by the AMT, and if so, what we would do about it. Here are the people that I would suggest have a greater likelihood of paying an AMT. First and foremost, those who live in high state income tax states. So if you're a resident of New York, a resident of California, where their state tax rates exceed 10%, there's a greater chance you'll be trapped by the AMT as the state income taxes are non-deductible. If you are fortunate enough to own a very large home, or maybe multiple homes, with big property tax bills, your chances of paying the AMT go up, as property taxes are non-deductible. Here's another way to think about AMT likelihood. If I'm below 158.9 in income, chances are I will not pay an AMT tax. And the reason is I enjoy the full exemption amount that probably keeps me out of it. For income above 158, and maybe more specifically above 492, where I've lost a portion of or maybe all of my exemption, my chances of paying the AMT go up. There will be some planning discussions that we'll have a little bit later today to talk about steps that you can take if you find yourself subject to the AMT.
John, thank you. Very helpful background and some good tips in there. Let's focus now on the planning opportunities that we should consider that might help us reduce the overall amount of tax that we pay.
Sounds great. So these planning recommendations, of course, are not appropriate for each and every one of us on the line today. They are somewhat generic in nature. Hopefully they're thought-provoking, and hopefully, obviously, in working with your friends at Planning Alternatives, you'll have a personal conversation as to which of these make sense or don't make sense given your personal circumstances. But we did want to introduce some planning recommendations that may have some relevancy in your personal circumstance. Number one, the first thing that we would suggest is you take a close look at where you hold different assets among your different accounts. As we know, diversification provides a great benefit, and it's the reason that your advisors construct portfolios that are well diversified to reduce risk. They include bonds, they include equities, they may include mutual funds, individual stocks, managed accounts, municipal securities, high dividend property, real estate, etc. Each of these different investment vehicles, of course, provide different return characteristics, but each of them have a different tax consequence. And so this recommendation asks us to think about not just which assets we own, but where we hold them between our different types of account structures. Most of us have two types of accounts: taxable accounts in our regular name and tax-protected accounts, such as IRAs and 401ks. It makes sense to hold in our taxable accounts any property that is long-term in nature. After all, there's a lower rate on capital gains that are realized in those accounts. And of course, anything that produces tax-free income, such as municipal bonds or closed-end muni funds, those are appropriate for a taxable account. Which assets should go into our tax-advantaged accounts, such as IRAs or 401ks? Anything that is tax not sensitive, in other words, tax inefficient. So funds that have high turnover may be best held in a tax-protected account to avoid paying taxes on the frequent capital gain distributions. Any short-term trading where gains are realized less than 1 year out, which results in a high tax rate, are better off deferred in a tax-protected account. And then any investment vehicles that produce taxable income, such as corporate bonds, preferred securities, or REITs, high distribution rates, but distributions that are subject to the regular tax system. And we want to protect those tax distributions by holding them in a tax-deferred account. Second concept is to consider municipal bonds and dividends in long-term capital gain assets, as was mentioned earlier, for your unique advantages. Municipal bonds, we believe, represent a great value and a great opportunity today. Municipal bonds generally come with a high level of security. There are, of course, always exceptions, including the high-profile names such as Detroit and Puerto Rico, but with appropriate credit research and appropriate professional management and diversification, investors can enjoy the best of both worlds: high-quality investments that produce income exempt from taxes. Let's take a look at the tax advantage of municipal income. Let's assume that we're able to generate a 4% tax-free yield in a municipal bond investment today. Assuming a marginal tax rate of 39.6 plus the incremental rate of 3.8, that 4% tax-free yield is equivalent to a taxable yield of 7%. That remains very attractive in today's low interest rate world and quite competitive. Let's go to the next slide.
Hey, John, I'm glad you mentioned these last two considerations, because I think they're often overlooked, and they're absolutely a component of our portfolio strategy. So thanks for bringing them to light. Let's shift to planning strategies that we might want to consider before the end of the year.
Sure. So typical year-end planning, and obviously every case is different, but here's the general year-end planning that we might suggest you start to take a look at, with, of course, the help of your advisors to determine personal relevancy. And it's to manage tax brackets. It's to engage in activities with a goal of lowering your total tax bill. Here's how we can accomplish that. Number one, of course, is by accelerating deductions into the current tax year. We have another 20-some-odd days to do this, so there may be time to enact some of these particular recommendations. Gifts to charity, of course, whether they be direct checks, direct property that is donated to charity, or maybe the convenience of a donor-advised fund that allows us to take a deduction in the current year, even though distributions from this fund may not be made until later years. The deduction is realized in the year that the contribution is made. Another concept to accelerate deductions would be to prepay prior to December 31 your state income taxes and your property taxes, which would provide a deduction for 2015. On the other side of the ledger are strategies to defer income into future tax years. So instead of realizing gains in our portfolios, we may choose to hedge our gains using collars or other derivative transactions. Another concept might be to recognize losses or tax loss harvesting to offset gains. I know this will sound funny to some of you on the line, but the losses in your portfolios are 50% more valuable today than they were a few years ago. Once again, capital gain rates have gone from 15 to 20, plus the incremental 3.8% net investment income tax. So the unrealized loss in a portfolio can be realized in this year in order to reduce the taxes on gains that have already been produced. Keep in mind, we need to wait 31 days. We can rebuy those securities to regain exposure to them, assuming they continue to make sense as part of our overall financial landscape.
Hey, John, you mentioned philanthropy, giving gifts to charity. What are some of the strategies you might suggest for maximizing our tax savings as we support the causes that we care about?
Yeah, thanks for bringing that up. I think that many of us, and I know your clientele, and I suspect they're wired in the same manner, we, of course, are all interested in achieving personal goals. Our personal retirement, the ability to lead comfortable lifestyles, the ability to educate our children and to provide for the next generation, those are all very noble goals and causes. But one of the things that I think ties us together here in America, or maybe ties us together as successful investors of your practice, is this goal of doing well for others and the benefits and the great feeling of satisfaction that we enjoy by helping those that are less fortunate through our charitable giving activities. Charitable giving reached an all-time high in 2014. Don't know what the numbers are going to be in 2015, but I suspect they'll be very impressive as well. Here's why. I think, number one, collectively we feel better today. We're more financially secure, given the increase in our investment portfolios and our real estate values over the past few years. Number two, we realize that tax rates are higher today, so the charitable gifts we make provide a greater tax deduction. Number three, we have large gains in our investment portfolios with the help of our friends at Planning Alternatives, and the capital gain rates on those gains are now higher, suggesting a gift of appreciated securities accomplishes two things. It allows us to support the charities we want while avoiding the capital gain deduction or the capital gain recognition on the securities that are provided. Donor-advised funds, I think, are a great way for many of us to consider becoming involved in philanthropy. Checks are great, but there are other ways to give even more effectively. The donor-advised fund allows us to make a very modest contribution of cash, or even better yet, appreciated securities. We receive an income tax deduction in the year of the gift. No capital gains are paid on the sale of the security. We can invest those proceeds in any vehicles or a number of vehicles held within the donor-advised fund platform. And then we can make distributions, the timing of which is up to us. We retain full control over when we make the distributions of differing amounts to different charities that we'd like to support both currently and in future years. And one final benefit is the idea that these assets grow tax-free and that they provide an additional opportunity to discuss charitable giving with our kids. My wife and I established a donor-advised fund a number of years ago. It was modest in nature, and of course we did it to support charities that we felt strongly about, but we used the opportunity to get our kids involved in the process, to understand what we had established, to do research on different charities that we would make distributions to to become more philanthropically motivated and to become more aware of the needs of others who might have a unique circumstance.
John, I love it. Thank you for those insights. Another popular topic in conversation is the idea of converting an IRA to a Roth, or a 401k to a Roth 401k. And while there are many different factors that go into that decision, can you share some of your thoughts on the concept?
Sure, absolutely. Thanks for that, Jim. Let me describe first the concept of a Roth conversion, and then let's talk about when it might be appropriate or beneficial. A Roth conversion, that concept has been around now for a few years. There was an AGI limitation that precluded many of us from considering a Roth conversion. That AGI limitation was eliminated about 5 years ago. So many of you on this call today might have taken a look at this back then. I would suggest that it's worth revisiting again. Here's how a Roth conversion works. We take an existing IRA or 401k, and we choose to convert it to a Roth account. Now, there is good news and bad news with that conversion. The bad news is that upon conversion, we pay ordinary income taxes today on the amount of the distribution. The good news is those dollars now wind up in a Roth IRA, where these dollars grow not tax-deferred, but tax-free. So by accelerating the distribution from this account and converting it to a Roth, we trade tax-deferred dollars for tax-free dollars. There's another advantage of the Roth. The second advantage is, unlike a traditional IRA, which requires minimum distributions from our retirement accounts beginning at age 70 and a half, Roth accounts currently have no RMD. So for those of us who would like to elongate the deferral process, allowing for greater compounding, or might potentially earmark these dollars for the benefit of our heirs or beneficiaries, Roths avoid the mandatory distributions associated with a traditional IRA. Who might consider a Roth IRA? Somebody maybe whose income is lower this year because they're between jobs or recently retired. Somebody who has significant losses that they might be able to use to offset the taxable income. An individual who's maybe in the alternative minimum tax, as the marginal rate under AMT caps out at 28%, suggesting an opportunity to do a conversion with a smaller tax bite today in exchange for tax-free growth down the road. And maybe the fourth type of individual who might consider a Roth conversion is the wealthy individual who has no immediate or future use for these dollars and would like to build a tax-free nest egg for passing on to that next generation. A couple of examples of those who might have a conversation with Nathan and Jim around the benefits of Roth conversion.
Excellent. You know, you don't often hear the issue of AMT mentioned when considering a conversion to a Roth, so thank you. That is helpful. What other opportunities might we consider relative to AMT?
Yeah, the AMT is a tricky one, and I think that's what upsets so many of us. It's the concept, I don't think, is necessarily one that is particularly offensive. The idea that everybody, including high-income earners, should pay their fair share of taxes. I think what upsets most of us is the complexity and the difficulty in calculating AMT and understanding the implications for most of our daily financial activities. I think that's what has many of us somewhat disgruntled with the AMT. So what can you do about AMT? Number one, if I'm in AMT today, please recognize that it may be beneficial to accelerate ordinary income. Now, I know that sounds unusual because typical year-end planning is to defer income as a way of avoiding the current tax bill. But if I'm in AMT today, for whatever reasons, facing a maximum marginal rate of 28%, it might make sense for me to accelerate my bonus check, make a greater distribution from my closely held business, exercise my stock options, or take a larger distribution from my IRA for the purpose of having those dollars taxed at the lower AMT rate of 28%. On the flip side of that conversation would be to defer the deductions that we would ordinarily take sooner. The payment of property taxes and state income taxes provide a deduction under the regular code. If I'm in AMT, it may make sense to defer those activities into future years where I receive an income tax deduction for them under the regular tax code. Once again, a lot of complexity here, and I think that's probably been consistent throughout our entire call today, which is why it's so important to have a conversation with your planner and your tax preparer to understand which of these strategies are appropriate given your circumstance.
John, thanks. This has been fantastic. You've shared with us how to reduce our tax bill, how we can support charity that's important to us. How about our kids and our grandkids? Planning ideas to help support them potentially.
Sure. Let's take a look at a couple. Number one, consider Roth accounts as a way of avoiding the kiddie tax and providing a jump start to those that we really care about. Many of you on this call may remember the UGMA accounts or UTMA accounts that we used many years ago as a way of building assets for our children and maybe providing them with a jump start in life, or potentially to use those dollars for tax savings when it comes to college expenses. Obviously, most of us have probably now turned our attention towards 529 plans, which provide tax-free growth of dollars that are used specifically for the purpose of saving for future college expenses. I would encourage you as parents or grandparents, if you have not already, to take a strong look at the 529 plan, as they provide us with an opportunity to front load a lump sum contribution and to receive tax-free growth on those dollars, with a very important goal at the back end, to pay for education for our children or other loved ones. The second concept that I'd like to introduce that's covered on the slide is to consider funding a Roth IRA. My 19-year-old son worked over $2,000 this year. We went ahead and we established a Roth IRA. Now, I have to admit to you, truth be told, he wasn't that excited about the idea. He had just earned this money. I'm sure he had other plans for the dollars other than funding his retirement account for a 40 or 50-year time horizon. But I encouraged him. I motivated him. I took him down to our advisor's office. We had a conversation around the benefits of a Roth IRA. And in order to encourage him even further, I matched his gift. I put my money where my mouth is as a way of encouraging my son to take a smart financial step. We did some quick math. $2,100 is what we contributed to his Roth IRA. We assumed a return of about 8% for 45 years. It almost grew to be $1 million. And so when I asked my son, Daniel, what did you think about this concept of a Roth IRA? He said, Dad, he said, I got to be honest with you. The idea of putting money aside for a long period of time was not particularly exciting to me. He said, I had a lot of things on my shopping list that I really wanted to use. He said, but there was one thing that really motivated me and encouraged me. One thing that made me feel really good about the decision we're making today. By starting early and benefiting from the tax-free growth, I can see a real large sum of money coming my way later in life when I'll need it. I encourage you to have this conversation with your kids and your grandkids to get them started on the right financial footing.
John, on this topic, we had a great question come in from the audience mentioning a concept we've encouraged our business owner clients to consider, and that is to employ their child in the family business for the purpose of then being able to take advantage of this very concept. Could you speak to that and as to why that can be helpful?
Sure. So assuming that we have younger children, maybe they're in their teenage years, maybe they're slightly older than that. In some circumstances, depending on the opportunity, if we're working somewhere else, our children may be going out and getting part-time jobs. Our children may be working over the summer and generating income. Keep in mind, please, that the strategies we've discussed of contributing to a Roth IRA, they have to earn income in order to be eligible to make a contribution. So no earnings, no contribution opportunity. And that's where your concept comes into play, Jim. Assuming that I have children, and my brother-in-law, for example, owns a closely held business here in the Chicago area. He's got 3 younger children. One of the strategies that we discussed and implemented a few years ago was putting the kids on the books. Now, of course, there are going to be some payroll taxes and some administrative expenses associated with it, But by putting the children on the books, we're able to accomplish a couple of things. Number one is shift income to recipients at a lower income tax level. And number two was to declare eligible income for those 3 children so that they in turn could fund Roth IRAs. Great concept for the closely held business owner who has the flexibility to employ his or her children as part of this planning strategy.
John, this is Nathan. Great commentary. Thank you so much. This has been incredibly valuable. We have a few minutes for questions, so anyone in the audience that would like to submit a question through their online access, please do so. And we have a couple of quick questions.
Sure. Well, Nathan, before we get to the audience's questions, I have a very important question I'd like to ask. This is probably the best question to start the engagement with. What are you planning on doing for your birthday this evening?
You know, it's a long list, so I need to start after we wrap up this webinar. So let's go to the questions.
Sounds good.
Good deflection. First question is, what is the difference between a Roth contribution and a conversion, and is there some sort of income limit to either one?
Sure. Let's talk about the two of them. A Roth contribution is only available to those at lower income levels. I don't recall the exact cutoff today, but I'm sure that Nathan and Jim can provide you with those income levels. They're constantly changing as they're indexed for inflation.
We have 183,000 for joint filers. That's where the phase out begins.
Yeah, thank you so much. I knew the number was around that level, but it does change regularly, which is why it's sometimes difficult to recall exactly. So for individuals with income levels below it, they should absolutely consider a Roth conversion for its advantages. For those with income levels above it, we're not quite as fortunate. Roth conversions are now available for everybody despite their level of income. There was an income or AGI limitation on the conversion. That is no longer the case. Let's differentiate between the two to make sure that we're clear. A Roth contribution is made from earnings. I work at XYZ firm today. I make $100,000 a year. I am eligible to contribute up to a pre-stated limit into my Roth IRA account for that year. And I can make additional contributions into a Roth IRA as I would ordinarily fund a 401k or a traditional IRA. Those are contributions from current earnings. The conversion concept that we discussed a little bit earlier has nothing to do with current earnings. It is relevant for those who already have an existing IRA or 401k balance. And the premise is to take a distribution from those accounts now and to convert those balances from a tax-deferred account into a tax-free account.
Excellent. Final question, and I want to thank the audience members for submitting them. Sorry we can't get to all of them, but the final question has to do with qualified distributions from retirement accounts for those over 70 and a half that have to take a minimum distribution and potentially give that to charity. This issue has been up in the air. I know there's some people that are waiting for some clarity on that. What's your comment or insight on that strategy?
Sure. Let's define the strategy a little bit further, Nathan. So Nathan brings up a great planning opportunity, and it's one that you may be somewhat familiar with. Let me help. For those of us who are over 70 and a half, we are very familiar with, I'm sure, the RMD concept, required minimum distributions based on the balance in our IRA. The IRS says, look, you've enjoyed many years of tax-deferred compounding. It's now time to take some money out based on your age and your account balance and your life expectancy. We require you to take out a minimum distribution each and every year once you turn 70 and a half. That distribution, of course, is taxable, and that's the IRS's logic. They want us to start taking distributions so they, in turn, can start receiving some tax revenue from it. The concept of this charitable gift from an IRA has been around for a few years, but unfortunately it's not a permanent part of the tax code. Each and every year we wait for Congress to eventually make a determination as to whether or not this planning strategy will be available to us. Here's how it works. For those of us who are 70 and a half and have a balance inside an IRA, a qualified account, we are eligible to take up to a $100,000 distribution and have that distribution go directly to a charity that we want to support. The advantage, of course, is that we're not taking a distribution in our own names, which would be fully taxable and increase our AGI income for that year, which has a number of adverse income tax consequences. Whether or not this is going to be a strategy available to us in 2015 or not remains to be seen. We'll keep our fingers crossed and our eye on the news releases to see if this is something you might discuss with your planners for 2015 purposes.
John, I want to thank you so much for taking the time to speak with us today. Your expertise has been incredibly valuable. We're just honored that you took the time out of your busy schedule to be with us, so thank you.
It's my pleasure. I'm really pleased to have been part of the call. Thank you very much, Jim and Nathan, for including me in this. I really appreciate your invitation to do so.
You're very welcome. I want to thank all of the attendees on today's webinar. Within 1 hour, you will receive a follow-up survey asking for your feedback, things that you enjoyed, also suggestions for future webinars. We rely on our clients to give us feedback and ideas and topics that they'd like to hear about, and we thoughtfully respond to those ideas and appreciate your input. One of the things that we want to provide to all attendees today is a tax preparation checklist. And this is a guide, it's a PDF form that we put together simply to help you organize your tax documents as you get ready for year end and move toward your filing deadline. For most is April 15th. So you will receive a link in the email that you receive in about an hour, and you can click that link, and on the page will be a PDF downloadable document that you can use for your checklist and preparing and organizing your documents for your tax filing. I want to thank Jim, I want to thank John, I want to thank everyone for attending. Hope you found great value, and please contact us. We appreciate having a conversation with you about planning for year end. This is also a great time of year to think about updating your financial plan, and as we move into 2016, that is a great time to look at your overall financial situation, put a game plan, put a sound plan together,